right, I'm just going to go ahead and get started since it's being recorded. Can you hear me, Fiend? I actually see my mic moving, so hopefully you can hear me. First concept I want to go over is trading ranges. So I think the key first is to identify what a trading range is. And this, let me change the color on this. Okay. I'm going to change these to white really quick. They're a little easier to see for anybody watching. So this is considered a trading range. And what a trading range is it's indecision in the market and almost what I like to call harmony in the market. So what that means is that buyers and sellers are both fighting for price discovery. So this basically shows indecision from both the buyers and the sellers. Now on my chart, a typical chart's red and green bars. These bars are currently white and blue. So blue representing bullish and white representing bearish. So I marked this as a trading range. And how did I do that? Well, you can see, and I could probably move this line up a little bit more. You can see where limit order sellers are at the top and limit order buyers are at the bottom. We don't necessarily need to go in depth on this concept. We can do it later. I think right now, a trading range essentially is where the market is discovering price. So you'll see a lot of up and down and up and down and up and down. And the computers and traders know this. So what they'll do is they'll put limit orders up here, like sellers will put limit orders to sell here, hoping that it gets hit and that it'll return back to the bottom. So this is where the concept of buy low, sell high truly comes from, not, buying low in a trend. You can't really tell the low of a trend or tell the low of a market. So we'll get into that concept a bit when we talk about trends. I have a great example here, and this is today's chart, by the way. So what's unique about a trading range is that if we were to take this whole time frame from this bar, well, we could take it from probably bar 38 to about bar 79. So we'll see the time, that's 1500. And this bar here is 1130. So that basically from 1130 to the end of day, we just trended. But you see how I have these marked in white. Now let's go to a higher time frame. We're currently in a 5-minute time frame. If we push out to, like, say, the 15-minute time frame, you could see that range gets smaller. And then if I push out to like the 30-minute time frame, it gets smaller. And this is obvious, right? But I'm getting to a point here. I want to find, okay, let's see, let's do 4 hours might give us what we need. Okay, so now this range has a tail, but it's probably easier to do this. Sorry for the confusion here. I'm going to take this bar here on the 4 hour, and then we'll zoom in to it. So this bar happened on the 13th of June. So we're going to find this bar on the 13th of June at 12:30. We're going to find where this is. I'm going to put those same white trend lines right here on this bar. I don't know why it's doing that. I don't want that. That's weird. Well, I am going to just do it on these two bars because these two bars are basically the trend or the trading range. Let's just do it on both of them, and then we will zoom into a smaller time frame and see what they look like. So 8:30. So this is basically all of or most of June 13th. So let's zoom back into the 5-minute and find June 13th, which is 14th. Okay, June 13th. Okay, so you could see the white lines here, and now I probably extend them a little further, and you could see how those dojis or those indecision bars that were on the 4-hour basically made a trend inside of a lower time frame. And that's important because if you look at this bar, we're looking at a trading range inside of a 1 minute time frame or so. And you can actually bring it out to these bars as well. But if you just saw this bar here, this next bar is a total breakout of that range. So just by looking at the prices, this is why trading ranges are important, is because just by looking at these two bars alone, you can see that there was a trading range breakout in a lower time frame. So most people look at these as dojis, they are dojis. But then when you get a strong bull bar like that, it's a potential breakout mode or just a potential breakout within a smaller time range, trading range. Also another key takeaway for trading ranges is that 70% of the time a breakout fails within a trading range. So you could see here we tried to break out and then we came back. You could see here we are breaking out. Most likely we'll probably go back into the range. 70% chance. It's a high probability chance that we'll go back into the range. And that's the reason why buyers and sellers, again, going back to the concept of buying low and selling high, they put their limit orders at the top or at the bottom of the range, hoping to get back to the other side of the range. The other stat for trading ranges is that not only do the breakouts fail 70% of the time, but 80% of the time they'll come back to the middle of the range. So if you do take a trade up here, so if you see, for instance, prices down here, you discovered that you identified this as a trading range, you might want to put your limit orders up here to sell. Once that sell triggers, you might want to take off most of your position halfway through the range, and then you can hope to get back to the other side of the range, which I think is another 50% chance. So this is a great way to trade trading ranges. Once they're identified, you just take advantage of that concept. Next, I'll move into, so these are market cycles overall. So that's the first concept of a market cycle. Next, I'll move into a channel. And a channel is basically a trend, either bullish or bearish. Most trends are channels. And it's similar to a range where price will go to the top, it'll fail to break out, come back to the bottom, fail to break out, go back up to the top, and price slowly pushes higher and lower until it finally breaks out. Give me 1 second. Let me pull up my talking points because, again, I'm not 100% prepared for this. So the other thing to know about trading ranges or channels rather is, and I showed an example of this in the chat earlier today. Let's take off this. Is that when price does break out, there's a 75% chance that this is just a flag for a continued move upward. And typically it could be the last move upward and then followed by a trading range behavior, which we see exactly here. So I talked about this trade and I'll cover it a little bit here. Let me take this other EMA off. This is the, oh, I have multiple EMAs on here. So let me take this one off. Perfect. So this is the 20 EMA. We saw a breakout forming here, comes out of the channel, which means typically we should expect 75% chance that we're going to go back to the other end of this channel, creating a new high. So the current high is here, and we did exactly that. But this is a really cool and easy trade for beginners to take, easy to identify. So this here is the Globex. This is the overnight trading low. And so this is a point of contention and resistance, and we broke above it. And you can see the bulls are fully in control here based on the size of the bars. Bulls are very much in control. There's some selling, but mostly bulls are in control. There's this pullback here, and we know that there's a 75% chance to go back up. So if we just fade this, there's a couple entry points here. There's a pullback here. This is our first pullback down. Then we have a retracement or a pullback, another pullback from the bear leg, and then we continue the bear leg down. So here's another what we call a second entry short. So this is the first entry short. This is the second entry. No, sorry. Yeah, this is the first entry short. This is the second entry short. But what happens is we get this giant bar here that seemingly rejects off this EMA, but it's a bull bar, and it's also, it doesn't necessarily close on its high, but it closes close to the midpoint of this bar. You typically want to see it over that, but what's unique about this bar is its size. It's sheer size, and the fact that we had a second entry long, knowing that we have a 75% chance to go back the other way, this sort of negates this second entry long bar. So it's like, it's a failure entry. So it's a second entry long failure entry. And so we can get in on this bar if we put a buy stop order one tick above, and that'll get us right back into this range here. That's not the trade I took. The trade that I took actually was with the algorithm that I created. But you can see this is your first entry long, this is your second entry long, and the algorithm says that these are very strong bars. So that basically tells you, I want to go short. But if you know, and you keep in your mind that 75% of the chance, 75% of the time we're going to go back to the top of the channel, that's going to be a useful stat for you to take this trade. This again negates it, and this bar is highlighted green just because it's a larger than normal bar. And then followed by this bar, which would technically be your first entry long bar. And some people like to put a buy stop over this bar. If you know, and you're going to use stats inside of if you're going to use stats and you want to see a better looking bar than this bar or this bar, this is a great bar to put a buy stop order right above. But then the second entry long is always your higher probability trade. So that's this bar here. And I don't want to get too far into those. We'll talk about two-legged pullbacks and second entry longs later, but they're great to get into trades. And you can see how this algorithm identifies it. So something cool that I've been working on for you guys. So that's channels. Basically, you're going to bounce inside of a channel. And the way that you want to map out a channel, let me explain how to map out a channel. So what I do is I typically identify the bottom of the channel first. And then see, I added this 15 degree, I added the degrees on the trend lines here. So first you identify the trend line, you highlight it, and then you want to copy that same exact line and find that same angle on the top of the top of the channel, and that'll identify your channel. So you can see price stayed within this, stayed within this, stayed within this. So this is a good channel, and it's holding this, confirming that this is the bottom of our channel at the very least. This is what we call an overshoot or an undershoot, however you want to define that. Since it's under the channel, you can call it undershoot. And that's where we see those extreme price movements back up to the top. So those are some cool, quick little stats. And you can even see we respected the top of the channel here, which is pretty cool after that new high. Let me put that back at like a 15. Copy this. Oh, it's at a 20. Yeah. So yeah, that's a 20 degree or 19 degrees. I guess it changes with my zooming. But yeah, you can see we practically respected it at the top here. So those are channels. Are there any questions so far, either for channels or for trading ranges at this point? If there are, you can throw them either in the Discord or this chat. Fiend, did you figure this out? Can you see my screen? I'm recording, so you can always watch it later too. Okay. Since there's no questions, I will move on to what else are we going to cover today? Not fully prepared, sorry. Trends. Okay. Yeah, so a channel is basically a form of a trend, and it does that bouncing back and forth. What I would consider a trend is more like a parabolic move. We kind of got some of that today. You know what? There was a day last week. Let me go back last week and oh, you know what? Let me show you one more example of this trend really quick, or these channels. Sorry, I'm bouncing back and forth. So here was the Globex. Let me change the screen. So the Globex is just overnight trading, as well as so the Globex is overnight trading for futures as opposed to just the daily US trading day. And the Globex formed a nice channel where we had some overshoots and we came back in to the other side. I'm a big inside trend drawer, so which means like I like to cover more points. I could make these further out to cover the extent of the channel itself, but I like to touch more of the limit order bars, these wicks, which are these here, of course, and here here we had this undershoot and a great trade setup where we had the undershoot here. And guess what? We came right back up to the top of that. We touched the top of that. And that was practically the high of the day, was hitting the top of this channel from the Globex. So if I take the Globex away, and this is pretty cool. You can take the Globex away, but I left the trend lines on for me to look at throughout the trading process. And you can see we hit right at the top. So another perfect trade setup to fade the breakout low, even though you saw these huge bars. And why is that? Because the reversal outside of here, again, we know we have the 75% chance to come to the top of this channel, but also we have these bears that were shorting up here and up here and up here and up here. They saw this move and they were like, well, now I'm finally making money on this because this was a trading range. I was going back and forth. We got the breakout we needed. Now let's start covering some of our positions and getting out of these positions. So that's what happened here. You could see they bought back the market here. They started taking profits a little bit. Here, I'll show you where they're taking profits. They started taking profits here, 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 here. And then finally, we started to get this reversal. And I'm going to go off on a little tangent. Sorry. So we got this reversal because this was cool. So then we got the bounce and we got this small tight channel. So what's happening in this tight channel is that the bulls, you can see how big these bars are coming in. This is still, I'm still bearish at this point because I think maybe this is just a bear flag. But you could see the bull is coming in and you can see how strong these bars are and how small and less frequent the bear bars are. So bigger bars, bigger bars, bigger bars, less bars, smaller bars, smaller bars, bigger bars, doji here. And we got to this point where practically is a trading range here. Let me change this color to white so you can see it. And boom, we got a breakout. And this would be considered a trend. I like to look at trends. I like to, and this is a trend. There's no pullbacks, right? There's very little pullback. This is a pullback, but a small one. This is profit taking by the bulls. But what happened is that these bears were selling here, trying to get back to here. So bears sold here. The bears that sold here and sold here and sold here are all trapped because they're not letting, the bulls are not letting them get out. Like I said, small, infrequent bars by the bears. So the bulls are trapping them. And then they get to this point, and now there's sellers here. So maybe these guys are still layering in to try to cover this position. So if they wanted to get out break even on a good trade, which I think if they wanted to get out break even on a bad trade from here, and they sold here, they got trapped, and they sold more up here, they would have to get down to here to get out of that trade. So they didn't get out of that trade. They're trapped. These guys, some of these guys may have, the guys that were selling up here, the guys that were selling up here may have gotten out at some point, but the guys that didn't get out now have to get out. So we trapped them, and the bears or the bulls trapped them by going all the way up here. Now these guys need to find price discovery because now they're going to fight again. And here's your harmonious trading range all over again. And then at the end of the day, you can see the bulls are trying, or the bears are trying to fight back to get, and these are strong bear bars. They're trying to fight to get back to a break-even point so that they can get out of their bad trade. And usually the market is harmonious and allows bulls and bears to get out of their bad trades, either break even or with small profit. So just went off on a little bit of a tangent, and we'll cover those in other courses, but I kind of wanted to keep this short. Sorry, I went off on that tangent. Trading ranges or trends. So when you have a trend, 80% chance that any reversal attempt of a strong trend is just a flag. So meaning we came from here. Here's our trend from the beginning of the trend all the way up. This technically is just going to be a flag. This attempt by the bears to reverse this, there's only a 20% chance that they're going to be able to reverse this strong trend. And that basically held true because we made another leg. So here's our first leg, pullback, second leg. And so that's kind of how trends work. Trends are strong, and it's important to know, and I'm going to show you another day this week last week that was really strong. And this is a great example of just a strong trend. Bear bars, bull bars closing over bull bars. I mean, we start back from here, but let's just do this. So, this is the beginning of the day. So bar 2, you can see this breakout here. So here's your trading range. This is a trading range candle. Here's your breakout. That's a strong breakout. A bull bar closing almost at the top, maybe 20% within the top of its range. And then the next bar, the open closing right in line or just above the close of the previous bar, and that just continues. That's a sign of a strong trend. Small pullback, continuation of the trend. Bears finally start to show up. It's just a small minor pullback. There's an 80% chance that we keep going. So why is that important? Because what I just showed you in the previous, here, we'll look at this. This is a good example because what I just showed you explaining like how to get out of a bad trade, it's important because here's a small bear trend. And it's important, you want to buy any bar because you want to go with the trend, and you don't necessarily have to wait for a pullback. Just buy the market, buy the close of any bar. You could buy the close of this bar, you could buy the close of this bar, buy the close of this bar, you could buy the market at any point in this small trend. Because if it reverses against you, like say you got in here, right? All you have to do is say, okay, I'm going to wait for this reversal attempt because you think it's a reversal attempt by the bulls. I'm just going to wait for a pullback in that reversal attempt. So then you wait for that pullback, and then you can buy some more here, and then you can determine, okay, since I bought more here, now to break even, so you buy the same amount, right? You could buy like say 2 future contracts. Say you bought them here. Now, when you wait for that pullback, you could buy 2 more here, and then you just have to wait for the market to harmoniously let you out of your bad trade, which it does. It gives you an opportunity here to get out of that trade. And you just have to look for that. But why would you go why would you go like half your size of trading? Why would you trade a small amount of contracts down here? Or that's what you should be doing. I didn't mention that, but you should be entering, if you're trying to catch a trend, you should be entering like half contracts. Sorry, my dogs are really distracting me right now. You should be buying half contracts. So if you buy up here at the top of this trend, you have to understand that bulls are going to start taking profit. They need to cash in on this nice move that they just got in. That doesn't mean that you still can't make money by buying this bar. And so you buy this bar, and now there's all this risk. So you don't want to buy at a full, you don't want to buy the bar at a full amount of your contracts. So say you normally trade with 4 contracts, you probably only want to buy it with 2 contracts, which is typically what I do if I'm trying to catch this ride. Because again, we have an 80% chance this is just going to keep moving higher throughout the day. And that's exactly what it did. So if you're buying up here, if you just wake up and you just buy it here, make sure you know that your risk is all the way down here. You want to keep your position, right? Like your risk at the very least is all the way down here. And that's the other thing, is that you need to keep a wide stop when you do try to catch these trends. If you catch it like right here, then you know your stop is down here. It's not that big of a deal. You're going to look for a 2-to-1 ratio, and the risk isn't all that bad. So maybe you might go in with like a third, you know, 2/3 of what you normally trade, or a third of what you normally trade, rather than going in with, or sorry, yeah, 2/3 of what you normally trade, rather than going with half of what you trade. And the reason why you go in with half is, again, because like if you bought down here in this large bear trend, if you decided that this bar was a good bar to buy on, you want to be able to get out of that position by buying more up here and then selling here, or selling more up here and buying back down here, essentially. And I don't know if I lost you guys on that, but we'll cover that in more detail later. The idea of a trend is that you can identify the trend by bear bars or bull bars closing on or near their highs and continuing to press above the close of the previous bar, almost creating gaps in the market. Now that's a strong trend. You identified it. Okay, don't wait for a pullback. Let me buy the close, buy the market, and understand if it's up here, I'm going to buy with less risk on the table, so that if it goes against me, I can buy back in. That's why you'll see a lot of people, well, I wait for a 50% pullback, because 50% pullbacks happen all the time. So from this breakout, from this breakout up to the top of here, to the top of that breakout, there was a 50% pullback from here to here. So if you bought down here, or if you sold down here and you're trapped, you could sell more up here and you can get out. 50% pullbacks are very common in the market. One particular reason is because there's computers and professional traders that know how to get in and out of trades without compromising their profits. I think I covered everything that I wanted to cover regarding trends. I covered probabilities on trends, probabilities on trading ranges, understanding buying low and selling high, and the actual concept of what people mean by that. It's typically in trading ranges. Remember that 70% of breakout attempts in channels or trading ranges fail. So don't get scared. Make sure you have your stop losses in the proper place. Make sure you're taking profit quickly in trading ranges once they're identified, because it's a lot of choppiness, and you can, miss your price targets very quickly. So it's important to understand, if I'm in a trading range, for instance, this tiny range here, we'll just use these 2 bars as our range. I see that I identified a range because we bounced here, we bounced here. You could see limit order buyers by these wicks. These are limit order buyers. These are guys that are when price comes down, they already have their limit set and they're pushing price back up immediately. So what I would do is set a sell limit order up here for something for later on. Or if I see this bounce to here, I might set a buy order down here. And again, we have an 80% chance of getting back to this side of the range, 50% chance to getting all the way over to the range. And channels are the same way. I wouldn't go against the trend in the channel. So a channel is a form of a trend, and essentially you do not want to go against the trend itself. So I would just set buy orders here. You can use ledges. You could say this is a ledge, and you could set a buy order just above it. And you basically want to be in the bottom 1/3 of each side, or bottom 1/3 of like the bottom of this trend when you're buying. And that'll help you get to the top of this. And any breakout is typically 75% chance it's a failure, and that'll return back to the top here. So those are high quality trades for beginners. And I did show an example of that earlier. And here's a great, let me do a 2-minute chart, show you the quick example one more time. And so here it is. We're actually right on it. Beautiful. So here it is. We were in the trend. We were respecting the trend line. We broke out. This turned out just to be a flag, a bear flag. And then we returned right back, creating a new high of the trend, or of the channel. And we broke even higher. And that was like a perfect setup where the bears got their 2 setups. And I'll use the indicator to show you. Here's the first entry for the bears. Here's the second entry. Second entry long is usually where you want to get in. So basically what happened here is bears got trapped. This was a great bar, pushed higher. Bears tried to win that bar back. They didn't get it. So that's essential failure on this bar. And we moved higher up on basically trapping the bears there. This is a first entry long for bulls, second entry long for bulls. And, you know, it turned out to be a fantastic trade. Back to the top of an actual larger range back to the bottom of a larger channel. So that same thing is actually going to happen. Take this off again, take these bars off and this off. So this same thing that just happened on this little move is actually happening on this larger channel. So we have a 75% chance of getting back to the top of this and creating a new high, which is also what I discussed in the room today. So that's it for me, guys. Do you guys have any questions? There's 5 minutes left before the recording is over. I'll check the trade room chat as well. Awesome. Well, thanks guys for watching the video. I did enjoy speaking. Hopefully you found it helpful, and I will also link the recording in our channel. I'll set it up an education station channel for us. Thanks again for coming. Bye guys.